Hey everyone, welcome to The Explainer. I am so glad you're joining us today because we are unpacking something that quietly but literally powers our entire modern world. I mean, think about the electric vehicles sitting in your driveway or even the smartphone you're probably holding right now. Those devices, they rely on a high-stakes, incredibly complex world, the global critical minerals market. Today, we're going to bridge the massive gap between heavy industrial mining, high-level corporate finance, and social equity. And I really think by the end of our time together, you're going to see global capitalism and resource extraction in a completely new light. Let's kick things off right out of the gate with this incredible thought. Social equity is a value-generating asset protection strategy, not a cost center. Let that sink in for a second. For decades, right, corporate boards have looked at community engagement as just a tax, basically a charitable donation to keep people happy. But today, we're going to experience a massive paradigm shift. We aren't just going to debate this philosophically, we're actually going to look at the hard math that proves this. Okay, let's dive into this. Here is our roadmap for today. First, the critical mineral power shift. Second, valuing subsoil assets. Third, maximizing machine efficiency. Fourth, the math of risk. And finally, equity as asset protection. Let's get to it. Starting with Section 1, the critical mineral power shift. Right now, the entire global economy is doing this massive pivot away from its historical dependency on fossil fuels. We're moving toward a decarbonized and defense-ready world, and the new currency of statecraft isn't oil anymore, it's rare earth elements and critical transition metals. Now, to really understand who holds the power in this new world, you have to look at the global value chain, which is heavily bifurcated into three distinct steps. Step 1 is upstream. This is raw extraction, literally digging the rock out of the ground. It's super capital intensive, carries high environmental risk, and surprisingly, it has a very low profit margin. Then there's step 2, midstream. This is beneficiation and refining. Now, beneficiation is just a heavy industry term that basically means treating the raw ore to improve its value. Washing it, crushing it, separating the good stuff from the waste. The margins jump significantly here, but it's highly consolidated and historically dominated by countries like China. Finally, we hit step 3, downstream. This is component manufacturing, like actually building EV drivetrains or advanced defense guidance systems. This is where intellectual property drives the absolute maximum margin. The further down this chain a country goes, the more geopolitical power it wields. And this brings us to a really fascinating real-world comparison. Just look at Botswana versus Nigeria. Botswana took its natural resources and demanded domestic processing. They established regulatory stability and wealth funds, effectively transforming themselves from an agrarian economy right into an upper-middle-income nation. They anchored international capital to local value addition. On the flip side, you have Nigeria, sitting at this massive crossroads. They possess world-class unmapped deposits of high-grade lithium and nickel. But they suffer from a traditional extractive export model, just shipping out raw ore and importing refined minerals. This creates what economists call a massive wealth arbitrage disparity, which is really just a fancy way of saying the country digging up the dirt stays poor while the country building the tech gets rich. To win in this new era, a nation absolutely has to capture that value domestically. Moving right along to Section 2, valuing subsoil assets. So you might be wondering, how do we actually put a price tag on these massive underground resources for the global capital markets? I mean, if a country wants to attract serious international capital, they can't just point to the dirt and say, hey, trust us, there's lithium down there. To convert a geological mineral resource into a financial bankable reserve, you have to use incredibly strict, transparent regulatory codes. You'll hear acronyms tossed around like IVS 230, IVS 500, Valman, and SAMVOL. You definitely don't need to memorize these, but what you do need to understand is that global institutional investors absolutely demand this intense mathematical transparency before they deploy millions of dollars. These codes require explicit, standardized disclosure of all the engineering data and economic assumptions. When you break down the three main valuation approaches, what's really interesting is how the specific stage of a mine dictates the exact financial valuation method you're legally allowed to use. The cost approach acts as an absolute floor for early-stage exploration, where you basically just appraise the historical cost of the drilling that's already been done. Then, the market approach is for early to mid-stage exploration. That uses comparable transactions, kind of like pricing a house by looking at what the house next door just sold for. But the holy grail? That is the income approach, which utilizes a discounted cash flow, or a DCF model. Simply put, a DCF model estimates all the future cash the mine will generate and then figures out what that future cash is worth to us today. This is strictly used for advanced or producing mines, and it requires dynamic pricing curves to account for massive tech-driven demand spikes. Which brings us to Section 3, maximizing machine efficiency. Now, we've spent some time in the boardroom, right, talking about global markets. But honestly, none of that financial math means a thing if the machinery breaks down out in the dirt. Financial valuation actually relies entirely on physical, operational efficiency out in the field. In asset-heavy industries like mining, value protection comes down to one ultimate metric: overall equipment effectiveness, or OEE. It's this brilliantly straightforward equation that measures how effectively a processing operation runs relative to its factory design capacity. You calculate it simply by multiplying availability by performance by quality. If any one of those three elements drops, your entire financial model takes a massive hit. Let's look at the actual downstream killers that destroy that OEE score. A mechanical breakdown of a rock crusher? That completely kills your availability. Running a plant at half capacity because of supply chain delays? That kills your performance throughput. An inefficient milling that flushes valuable lithium right out into a tailings pond? That completely destroys your quality yield. But here's the really incredible part. By switching from reactive maintenance to an asset performance management system using IoT edge sensors, we're talking things like thermal and vibration monitors that actually tell you a machine is sick before it dies. Operators can reduce unexpected capital expenditures, or CapEx, by up to 30%. And CapEx is simply the massive, expensive equipment purchases required to keep the mine running. Slashing those unexpected costs adds direct value straight to the bottom line.
All right, Section 4, the math of risk.
So how do those physical, on-the-ground operational realities and regional politics actually feed back into a corporate financial model? Well, it beautifully balances out mathematically. When we value a strategic mineral asset, we use a net present value formula. To calculate this, we start with a base weighted average cost of capital, or WACC. Think of that as the baseline return investors expect to earn just to show up. But then we have to add the security risk premium. This is an actual mathematical percentage point penalty added on for regional instability, friction, or mineral theft. But balancing it all out on the other side is the handshake and the heart, the social justice discount. It's a credit deducted right back off that risk premium when you integrate the local community. Geopolitical friction and social equity aren't just some abstract HR concept. They are literal, quantified, mathematical variables in corporate finance. Which leads us to the literal million-dollar question: does social justice actually pay? Well, let's run a real scenario. Imagine a lithium mine generating $20 million in net cash flow in year 5. If you exclude the local community, your base discount rate of 10% gets hit with a 6% security risk premium because of local friction. That is a massive 16% discount rate weighing down your valuation. But what if you grant a 10% carried equity interest to a local community wealth trust? Now, a carried equity interest just means giving the community a slice of the ownership pie without requiring them to cough up millions of dollars to buy in. That integration creates a social justice discount that knocks 4% right off your risk premium, dropping your composite rate down to 12%. So what is the exact difference in the present value of that single year 5 cash flow when you drop the discount rate from 16% down to 12%? It is exactly $1,826,357. No way, right? That is nearly a $2 million bump in present value. And remember, present value means that's $2 million added to the asset's value today for just one single year of operation, simply by formally integrating the community as equity stakeholders. If you extend that math across a 20-year mine life, the numbers become absolutely staggering. And that brings us to our final stop, Section 5, equity as asset protection. This mathematical reality demands a complete, ground-up overhaul of how mining consortiums deal with host communities. If exclusion creates a governance vacuum that just invites illegal mining, sabotage, and security threats, then the ultimate defense is inclusion. To build a secure and fair sector, assets have to be structured around 3 pillars of co-ownership. We call this the tripartite equity architecture. First, you have the sovereign regulator. That's the government providing the legal titles and collecting taxes. Second, the operating partner, the international investors bringing the heavy capital and tech. And third, the host community. As we just discussed, they receive a 5 to 10% non-dilutable carried equity interest managed by an independent board of trustees. This equity gets channeled into a community wealth trust. It funds sustainable infrastructure like solar power and clean water, education, and crucially, direct dividend payouts that are intrinsically tied to the mine's daily production. Let's slow down and really think about human nature for a second. When a community's roads, their schools, and their direct financial returns are inextricably linked to the daily operational throughput of that mine, the incentives shift entirely. The community instantly becomes the primary protector of the asset against illegal mining and theft.
They are financially incentivized to make absolutely sure that operation runs as smoothly as humanly possible. We've covered the geopolitics, the engineering metrics, and the undeniable financial mathematics. Social responsibility isn't just some moral obligation acting as a drag on profits, it is a mathematically proven reduction in corporate risk. So I'll leave you with this final provocative thought, and it's a new paradigm I really hope we've discovered together today. Moving forward, will we continue to treat community equity as a burdensome cost center, or will we finally embrace it as our most powerful, value-generating asset protection strategy? Thanks so much for joining me on this explainer. I really hope it changed the way you see the world.